Hey, welcome back to the channel. It's Randy Hatata here at Xpand Realty, and we do have a special guest going by the name of Dax Tobin from Millennium Lending. And the reason we're here today is that we have a special announcement. If you haven't already heard, which we're hoping you heard, so that we can piggyback off that. But a lot of our clients and a lot of the world, thousands of people have been waiting for the feds to make some decisions so they can plan out their future, and especially in the real estate market. And yesterday, the news is that the feds announced slashing rates. And what does that mean? I'll let Dax kind of dissect that for you. He is the expert. He does come from the financial world prior to the lending world. So he'll have a good grasp and a much more professional experience level to define what everything means and how it affects us. So that's why he's here. And let's start with, so I've heard that the Fed slashed interest rates 50 basis points. And I believe we were expecting like 25 basis points.
Yeah, it was kind of a toss-up, actually, whether they were going to go with 25 or 50, but they went with 50, which I think was the best move, and then they'll probably follow up this year with another 25 basis point cut 2 times.
Cool. So let's start with the basics.
Okay.
Can you explain what a basis point is?
It's 1/100th of a percentage. 50 basis points is a half of a percentage point.
And what rate are we talking about when they say Fed cuts rates?
So it's the Fed funds rate. They control the Fed funds rate, which is not directly related to mortgage rates, but it does affect all other rates in the whole world. It's the most powerful rate in the world. So it will directly affect prime rate, which is what second mortgages are based on, and a lot of other rates. That is the rate that banks that they recommend that banks borrow from each other at. They also affect the discount rate, which banks can borrow money from the Fed at, and banks borrow money from each other at on an overnight basis. So that rate will have an effect on all the other rates in the world, and bonds, treasuries, mortgage bonds, everything else. And it also affects how quickly or slowly the economy will slow up or slow down or speed up based on how easy it is to get money for businesses to grow and those types of things, and consumers.
Can you sum that up into one simple sentence so that when people ask me, which they do, what rate are we talking about?
Well, it's not a rate that will affect a consumer directly. So it is more of a business rate. So when, like, after the rate was cut yesterday, we got a lot of calls at our office with people hoping to be able to refinance their mortgage rates by a half a point lower. And
we'll get into that.
That's not the way it works. In point of fact, immediately after the announcement, our rate sheets across the board got a little bit worse. And then they recovered a little bit, and today they're about the same as they were right before. So in anticipation of them cutting their rate, mortgage bonds have been moving down. The rates on mortgages have been moving down. The bond itself, the price of the bond, has been moving up. So mostly mortgage rates, which is what most people listening here are mostly concerned with, I would imagine.
Well, we'll get into the summary at the end.
But they are most. They move in anticipation of what's going to be happening with the Fed rate.
Okay, so it's a proactive movement.
In
or
most
is it
cases,
reactive?
Well, it's in anticipation of what they expect to be happening.
So proactive. All right. So I think that's a huge point, is that there's a major misconception on the rate we're talking about. When I talk to the public, I know there's a lot of confusion, and a lot of confusion comes from when they hear rates are cut, they think it's mortgage rates, or a lot of people think that, and obviously you cleared that up for us. some also think it's the prime rate, which it's not as well. So I think that's a good educational piece there, and kind of a myth buster on exactly what rate we're talking about.
Yeah.
And I know you said they're not completely affiliated, but they are correlated with mortgage rates.
They are. Over time, they tend to move together, but in any one particular day or even weeks at a time, they're not 100% correlated. But they will be correlated over time.
Cool. All right. So that's out of the way. We kind of know what rate was slashed and how it's going to affect mortgage rates. And we're going to ask you the big question later on what you expect in the marketplace for mortgage rates in the near future. But with all that being said, I think that misconception we just addressed changes the market overnight as well, because as we spoke before this conversation, you shared that you've already had whatever it was, 5 to 10 calls talking about refinancing and all that, because most people think that the mortgage rates just dipped immediately. And I think the misconception in the real estate world, or even in your mortgage world, is that when an announcement like that is made, people automatically think that mortgage rates just got cut, and all of a sudden it goes from 7 to 6 or 6 to 5 or whatever it is, right? And that there's an immediate change in the mortgage rate, which is not the case. I know you said that this could just spark gradual changes over time in the mortgage interest rate world. So is that true?
That it will lead to lower mortgage rates?
That that it's not just one big change overnight. It's a beginning of more change.
When you see very rapid changes in mortgage rates, it's usually due to an unanticipated event in the marketplace.
Well, that's what happened the first time when rates went up last year, mid-year, right? We had a huge spike.
Well, whether they go down or they go up, it's almost always due to an event that is unexpected, whether it be some sort of event, an announcement, or some type of geopolitical event, or anything like that. It's unanticipated. And that's when you get a major movement in a day or a week or a trend over the course of a couple of weeks where there's follow through afterwards. But things that are projected out, like this has been projected now for months ahead of time, when the event actually happens, it's somewhat of a non-event.
Well, we have our buyers that have been waiting like a year
but
hopefully.
Now rates have been moving down over the course of the last month and a half, and they've been moving down to set this up, and it happened as expected. And as if it continues to happen as expected, the reports come out, the job reports come out, the inflation reports come out, and all the things that are expected to happen over the next 4 weeks, 6 weeks, 8 weeks continue to happen as expected, then we should continue to see a gradual decline. But nothing ever happens as expected. And so the question is how unexpected will those reports be? If they are completely out of line, the election will have an effect on some of that. So if things do not happen as expected, then things could change. They could put a pause on some of those rate cuts. If inflation starts to tick back up, if the jobs reports are not what people expect, those things could change. They've been expecting these rate cuts here. We've been hearing about rate cuts for a year and a half.
Yeah, and it's been years.
They never happened.
It's been years.
Well, so this was the first rate cut in 4 years, but they've been talking about making these rate cuts for at least a year and a half, very strongly, and maybe possibly 2 years now, and they just kind of got pushed back. So, that's why it is dependent on the data. It is dependent on what happens, and things change. There's a lot of data points that go into these decisions.
I'm going to make this a simple yes/no question.
I'll try to give you a yes/no answer to something that might not be that simple.
I corner you like that, right? Is this correlated to the election?
What just happened today?
Yes. Yes.
I don't think so. No, I think they try. I think the Fed, all the members of the Fed, that body tries to be neutral in that regard. I don't think they play into that.
Okay. All right. Well, see, that's another myth buster right there, because a lot of the talk on the street is that due to the election, historically we've seen interest rates dip, so that's probably going to happen.
Well, there are other factors that could play into that but I don't think the Fed's decision regarding what they're going to do with interest rates and how they assess all of that has anything to do with politics in that regard. At least it shouldn't.
Yeah, understood. All right. Well, fair answer. So in August, second quarter, I believe it was, interest rates spiked major and went from like 3 or 4 to 7% or whatever it was, something like that, right?
In when?
Last year, second quarter or mid year.
Second quarter of 23.
23.
Okay.
Yeah. Well, for mortgage rates, I remember it very well because our market was going crazy ever since COVID. All the way through COVID years, all the way through that time in 2023. We were used to 3-4% interest rates, and then we seen a major spike, and then our real estate market flattened in the fact that buyers stopped buying. There was some sticker shock on price, interest rates and mortgage payments. Inventory went up. Sellers started panicking and slashing prices, and the long story short is our market flattened. It didn't dip, but it flattened, and sales really slowed down. So I remember that very well. So what caused that quick increase in interest rates last year?
In August of 23.
Was it August?
Well, I mean, there have been multiple spikes in interest rates over the course of since interest rates began to rise about 2.5 years ago. We've had fluctuations. We've had, interest rates rise and then they come back down a little bit, and people think, okay, well, maybe this is the beginning of the decrease and we're going to head back down, and then they go back up again. And
well, last year we had a big movement from like 2 or 3 points.
Yeah. I mean, that has happened. They never really they got down, down into the mid 6s, and then they climbed all the way up to about 8%. And there was a time period that was just about 8% there for a short time period. And I can't recall exactly what the reason was for that.
Wasn't it the Fed stopped buying the bonds and all that?
Yeah, there was some of that going on where they were going to, instead of buying bonds, which they have been historically,
started selling them.
They started selling them and not letting them just roll off their books, which is a big deal.
So that
when it's supply and demand. So when you stop buying something and you just
because they were artificially buying it to try and hold interest rates down prior to that, right?
Correct. Yeah. And that is that is a big deal that most people don't really understand about what has taken place in the market over the last many years. Is that the biggest buyer of mortgage-backed securities and treasuries has been our own government.
So our government has been buying them, artificially holding mortgage rates down, and when they stopped doing that, everything adjusted very quickly.
Correct. That was one of the reasons, but it was a very major factor in it.
Yeah, I get it.
Yeah, it's a big deal.
Yeah. Okay, so
they had to release. They had, I think, at one point they had over $9 trillion. I want to say $8 or $9 trillion in mortgage-backed securities and treasuries on their books.
It's crazy, when we talk about millions, then billions, then trillions.
Yeah.
It's hard to grasp how big that number is until you see it on paper, and the difference between 1 million to $1 billion, to $1 trillion.
It was over $4 trillion worth were purchased just in a very short time period after COVID.
It's crazy. How many billions make a trillion?
1,000.
1,000 billion makes a trillion.
Yeah.
That's a lot of zeros. I can't even count that high. All right, so we got that out the way. We got a lot of clarification and definitions and all that good stuff. So here we are. What is our current, well, I know you're going to give me the attorney answer on this one. It depends. But what is our current interest rate now? Very generic number.
So for a 30-year fixed interest rate, of course, it does depend on a lot of different factors, but, most of the time, we're quoting something in the low to mid sixes on a 30-year fixed interest rate.
Low sixes. I got to ask you that way because that's how I get asked.
Yeah.
Elevator talk, it's like,
Sure.
Hey, what's interest rates today?
Yeah.
They're about, and then we come up with a number.
Yeah.
So now I'm going to say low sixes.
Yeah.
All right.
I think many people will qualify for that rate in many instances.
So as you know, you represent buyers, I represent sellers. The buyers have been in hibernation mode, waiting for interest rates to adjust downwards, obviously.
Yeah.
And a lot of them have been waiting since last year. And it affects both the sales market and our rental market, because when people don't know what to do, nothing happens. And our renters aren't moving, they aren't renewing, nor are they buying, nor are they relocating, because a lot of people think interest rates are going to dip soon. Now, we saw a huge uptick in Las Vegas sales January, then February, then March, all the way through 2 months ago. And a lot had to do with, I feel, consumer confidence came back, and the fact that buyers just got tired of waiting for interest rates to dip and got used to the numbers, which historically is pretty good number at 6, 7. But the long story short is that a lot of people started buying because they got tired of waiting. And luckily they did, because prices have come up quite a bit since then. Now, the rest of the buyers who haven't bought yet are waiting for these interest rates to dip. We're training them that, hey, try to be a little bit more contrarian, because all the buyers that are doing the same thing as you are going to jump into the market at the same time as you, as soon as they hear interest rates have dipped.
Yep.
And that'll probably cause prices to rise at that time. So what we've noticed is that there's been a standstill. Sales have been slow. And I feel like beyond all the other factors that's going on, there's a theoretic hypothesis of a timeline that it's going to happen within. And that timeline is before the election. So a lot of people are thinking, including myself, that interest rates were going to dip this month or next month, which gives us kind of like, hey, we're going to know within the next month or two. Let's just wait it out and find out what happens. And so our renters are paused, our buyers are paused, and inventory is growing based on that. We're training some of our buyers that, hey, this provides opportunity because, there's ways that we can combat interest rates based on heavy negotiations, because things are more negotiable when there's less buyers in the game and more inventory, which is happening now. So I guess, where you come in is kind of advising us on what your thoughts are as far as like what to expect. My thoughts are that interest rates will slowly come down based on this announcement and other things going on soon.
Yeah, well, I mean, I think my advice during this entire time period has been the same, and I think it's been for people who took the advice and bought, say, a year ago based on this, or 18 months ago based on this, 2 years ago based on this, and bought and had a 7.5% interest rate or an 8% interest rate. I'm calling those people right now saying, hey, let's refinance that property you purchased. That, let's say they bought a $500,000 home 18 months ago or 2 years ago, and they have a 7.5% interest rate. I'm calling them now saying, let's refinance that to 6.5 or 6.375 or something, a point or more lower. And, your house is now worth how much more? 10% more, 15% more.
Yeah.
So they're getting the best of both worlds because they're getting today's rate and they have all this appreciation in the home, and they're not competing, with all these other people to purchase in a new market.
Well, is today's rate better than tomorrow's rate?
Well, it doesn't matter because you'll get tomorrow's rate when tomorrow happens. So, if you do the financing correctly, then you can refinance into those. What I usually recommend for people is that they don't overspend on their refinance. They don't, in a declining interest rate environment, you don't want to go in and, buy your interest rate down with a whole bunch of expenses, because you'll likely get that buy down again for free in the future. So, limit your expenses. There will be expenses with any refinance, but you'll recoup those expenses pretty quickly. And then if rates go down again, capture it again, and just do it all on the way down. And in most instances, you're going to save, depending on the size of the loan, hundreds of dollars a month. And then, if it happens again, you can get another point and a half out of that, do it again. And then, at some point it will stop, and rates won't go down anymore, and you will have captured it. So you did it 2 times.
Well, most people don't do a mathematic formula to figure all that out and what the break-even time period is, for that to make sense. So I think a lot of people are just like, hey, I was at 7, it's at 6 now, it's time to refinance, without like, how much is it going to cost us? How long is it going to take to break even on those expenses?
Sure.
And I think you would help with that mathematical equation, right?
I always do that. And it's
but people don't know that. So,
but not only do I do that when it's, but I do that at the time of the purchase as well, figuring out, okay, when will it make sense for you, so that we know when it's time to look at this again in the future. How much do we need to be able to save? How much are the expenses going to be, so we know when to make the call in the future?
Because refinances are normally not free.
No, they're never free. There's always a cost associated with a refinance. It's just a question of who's paying for that cost.
Yeah, I understand. And we're talking about the buyer, the owner now paying for those costs. So for them, I think it's relevant to figure out like how much change in interest rate is it worth it to do a refinance, so that you can get the timing down if it's worth to do it.
It depends on the type
tomorrow,
of loan.
right?
It depends on the size of the loan.
And how much equity you have.
Well, equity is a part of it. If you're getting rid of mortgage insurance, that's a huge part of it as well, because that adds to the savings. But if you have a larger loan, if you have a $600,000 loan versus a $300,000 loan, in many instances the expenses are very similar. So your savings will be twice as much on a $600,000 loan as it will on a $300,000 loan. So your break even is going to be longer on the $300,000 loan than it will be on the $600,000 loan. So you need a bigger interest rate savings on the smaller loan in order to recoup your costs.
Oh,
so that's why every one of those calculations is different.
See, that's something I just learned, because I didn't realize that the expenses were about the same.
Yeah, because
it makes sense.
Yeah. I mean, because you're going to pay for an appraisal. The appraisal really isn't any different. The escrow fee is pretty much the same. The title insurance may be a little bit different, but overall, the underwriting, the processing fee, all the same. So that's why when somebody says, "Well, how much lower does the interest rate need to be?" The answer again is it depends. So we make those calculations and we figure out what's best for you, your situation, and the larger the loan, the less the interest rate needs to go down in order for it to make sense.
I'm glad you're here, because my phone has been blowing up through this whole meeting, and I already know what I'm getting called for.
Yeah.
And I'll have some answers for them ready.
Yeah.
I'm going to tell them Dax told me. So.
That's a really important concept.
No.
Yeah.
Well, that's great. So that rolls right into, like, I talked about our last video, if it's out yet, about the opportunity to buy brand new homes based on a lot of builders' fiscal year that ends November 1st, and their pressure to sell within a timely manner or close homes before November 1st so that they can make their bonuses and hit their quotas, long story short. So with that being said, you're talking about being careful of spending expenses on the mortgage, which is equal to which is relevant to refinances and to purchases. And so strategy-wise, instead of taking builder credits and concessions and applying them towards interest rate buy-downs, it might be smarter to take that money's offset expenses such as closing costs and the cost, which is part of it is the cost of the mortgage itself, so that you have those funds knowing that interest rates will probably go down for free, so you don't have to buy them down, and then use that monies for that refinance.
I would agree with that. Yeah.
Yeah.
So in most instances, when you have money from any contributing party, whether it be the builder, the seller,
Seller, same thing, because resale is slower. We just talked about.
Any contributing party, I would, in almost any instance, I would recommend that you use those funds to pay for all of your hard fixed closing costs first. Your actual fees and expenses, and then your upfront taxes and insurance, because those are things that you're paying for out of pocket right now. And then when you're done with that, if there's anything left over and you want to make any contributions towards an interest rate buy down, then that's fine. But if you're buying your rate down, all your before you pay for those expenses, I don't see the point in that, other than if you want a psychological benefit of a lower payment, because you're coming out of pocket with that money now. That if it's $10,000 in closing costs, and you want to apply that towards a lower interest rate, you're saving, say, $250 a month, but you've paid $10,000 in closing costs out of pocket. You're just giving the bank your $10,000, and you're getting $250 of it back a month.
It's funny that you say psychological, because a lot of this is psychological.
Yeah.
And I think it makes a big deal to a buyer saying that when asked, what are you paying your interest rate?
There is one instance where that could potentially work and be necessary for a temporary interest rate buy down, like where you hear out in the market, there's like a 3-2-1 or 2-1 or a 1-1 buy down, where you're only getting the benefit of the interest rate buy down for the first 3 years, 2 years, or 1 year. You do not qualify based on the new interest rate. A permanent buy down on the interest rate, where it lasts the whole term of the loan, whether it be 15, 20, or 30 years, you do in fact qualify based on the lower rate. So if you are pushing right up against your maximum qualifications, and you have a, say, 6.5% interest rate, and then you're going to use monies from the seller, the builder, whoever, to buy that interest rate down to, say, 5.875, and it's permanent, and that's the only way you can qualify for the loan, then that could be a strategy that in that specific instance might be appropriate, might work for you. But I find that to be pretty rare.
Yeah, so that's another curveball. So are you saying that in anticipation that interest rates looks like they're going to dip in the future, then a 3-2-1 buy down sounds like a good idea?
It's neither here nor there, because I think you're gonna receive the benefit of that. If you're going to have that buy down there, I would pay for all your closing costs first, and you would have to have a lot of money from the seller in order to have all the closing costs paid, and then have enough money for a temporary interest rate buy down. And if you do, great.
Closing costs averaging about 3% right now, right?
So I mean, you would have to have, say, 5-6%, then you can use the extra money towards a buy down, say, of the first year or the second year, or something like that.
Yeah.
Yeah.
Because I think unless the seller pays for it, a lot of people forget that you're paying for that.
Yeah. So if you pay for your own buy down, what's the point? You're paying directly for your own interest rate buy down, which is simply giving the money to the bank to hold on for you so that you can get it back.
To me, those are hard decisions, but it's it's easy to make the decision when you have a mathematical formula in front of you, just saying, here's your options and what it means to you, right? Yeah. And so I think people like Dax is certainly valuable specifically to make that decision, right? Regardless what that decision is. Now, I think the market's going to start picking up, and I think based on the interest rates hopefully coming down, there's going to be some huge changes. We talked about the psychological effect on buyers. I truly believe that there's going to be a huge psychological effect. And I say psychological in the fact that there's not that much difference, and correct me if I'm wrong, between a 6% interest rate and a 5.99% interest rate, right? And I think psychologically, a buyer is going to feel way better having 5.99. And so when people ask them, what's your interest rate? They can say, I'm in the fives, 5.99. Kind of like that.
That's why they have those.
The Walmart roll down, right?
Yeah. Yeah. When we have our interest, the options to choose interest rates, there's a 6 and a 5.99, and there's also at 5.5, there's a 5.49, and it's for those reasons.
Yeah.
And I mean, it just makes sense.
Yeah. People tend to pick the one in the middle.
Well, I think it's just human nature. People, I would want it.
I get it.
Yeah.
I get it. Yeah. But even if they paid for it to look that way,
no, there usually is very the difference between a 6 and a 5.99. You pay very, very little for it.
Right, but it feels good.
It feels good.
So there's a psychological effect based on that. All right.
Yeah.
All right. So my opinion is that if we get into the fives, whatever that may be, with the point whatever, I think there's going to be huge consumer confidence just simply because we're in the fives versus the 6.
Agreed. I do agree, yeah.
And so I think that's going to really spark the market. Now, what's really going to change, though, and I know this for a fact, is that because this is a game of numbers a lot of the time, especially for investors, our real estate investors are going to be specifically motivated to get back in the market if they can make their cash flows work.
Yeah.
Because we've been struggling to hit break-even cash flows when they're using financing.
With say 30% down, for example, as opposed to having to put 40+% down.
Right. Accurate statement. Yeah. Most people are thinking 25% down, and for us, with the 25% based on the price points today, interest rates today, we're struggling to make that cash flow positive. Yeah. Long story short. But I think rents will climb in the future along with inflation. I think interest rates hopefully will go down. And I think investors are going to come back in the game as long as we can hit break even or positive. Whether that's good or bad is not that relevant. I think it's just going to happen. What do you think?
Which part?
Investors coming back if
we
can hit cash flows.
Sure, yeah. I think that has, for the Las Vegas market especially, I think it has been one of the things that has kept a cap on some growth, because it's been historically been such an investment heavy market. And as soon as, I noticed it, I think, people in real estate noticed it, as soon as you could no longer, in general, put 30% down on an investment. 25, it was historically 25, and then it kind of moved up to 30% down on an average, investment property, single family residence, and break even. That's when, people started exiting the market. And then, it became 35, and then in many cases it was 40%, and that's a real problem, right?
Well, because the more cash out of pocket, the less investors that have it are in the marketplace, right?
Yeah. As soon as that number starts to get more in line with what traditionally people view as what they want to put down on a home for that type of thing, I think you're going to see a lot more people doing that. And I think it's going to help a lot.
Well, what I see based on everything we've talked about is opportunity. And I mean that across the board, and not just for me, not just for you. I'm talking about for everyone. Because I think buyers will benefit from lower interest rates. I think sellers will benefit from lower interest rates. I think investors will benefit from lower interest rates. And I think our market is going to change. And, we can talk about how it's going to impact your average consumer here in Las Vegas, because it's going to change the climate of real estate in general. And there are concerns about us continuing to be an affordable city? To be determined. But eventually, I think affordability is going to get less and less and less here in Las Vegas based on the demand and limited supply, which a lot of people don't know about.
I think they need to start building more homes that are in the price range that that people can afford in that sort of $300,000 to $450,000 price range. Because for a long time, the builders were just ignoring that price range.
Well, they're looking at profitability,
Yeah.
and whatever they can, sell with the most profit is the product they're going to build, right? And I know for a fact that land's been expensive, and so they got to either build more homes, which they're having trouble with getting the density for that.
Correct. Yeah.
So they have to build bigger homes to hit that profit margins.
Yeah. So I think that's going to be the biggest issue we're going to have. But obviously, that's something you know a lot more about, but that's the issue that I'm finding, that the buyers that I pre-approve to go out and look for homes is that they have a certain amount that they can afford relative to their rent, and then they go out and they try to find that home, and it just doesn't exist.
I mean, here I'm going to go out on a limb and say, like, from a professional standpoint and what I see, the only way affordability is going to work or get better is, I don't see land, number one, going down, right? Because it's limited. So without that going down, then how is affordability going to work? To me, the only way it works is they allow higher density, and that's when we become more of a metropolitan, I believe.
Yeah, we have to have a lower interest rate environment, more and they have to be able to build more homes.
Yeah, and we're running out of land, though.
Yeah.
Being that we're in a valley.
Therefore, the density.
Density.
Right? Yeah.
Whew. We're going to be a city, Dax.
Yeah. And I don't know about the land issue and how that's going to get solved, because I've heard a lot of different theories on that, and what type of land is appropriate for building, and what the BLM will release, and who controls everything. But from my understanding, that there's a lot of the land that people believe can be released isn't necessarily fit for building in the first place. Right?
Yeah, some are in flood zones. Most are commutes already. And a lot does not have the infrastructure because it's in the middle of nowhere.
Yeah, or the type of, just the topography of the land itself is, sand and
mountains
shifts and those kinds of things. So, yeah.
All right. Well, I think that was a very healthy conversation. I think we all learned something. Well, I know I learned a nugget today. Anything you want to leave on the table?
Well, I think that for most people, I think that the one thing that we didn't quite touch on was just that I think that there are a lot of people who are waiting for interest rates to go down, and then they're waiting for the election and to see kind of what happens there, and anticipating that there will be some sort of outcome from that will benefit them. And that may or may not be the case. But I think that planning for what is best for you and your family is always a good idea, and be ready for whatever direction that takes. And having a meeting with somebody like me to go over what all your options are, so you can be prepared for the outcome of an event like that. Because you may end up being surprised at what you're capable of doing or not doing, and then you may be preparing for something that you're getting ready for something that it happens, and then you're caught off guard based on what your capabilities are at that time.
It starts with where you are, right? Yeah. Here's where I'm today. Here's where I want to go, and then there's so many paths to get there, and
yeah,
I think that's where
there's a lot of people that I speak to, and then they go, okay, I've been waiting for this to happen, and I'm ready to go, and they say, well, great, now we need to do something for the next 2 or 3 or 4 months to prepare you in reality for what you need to do. So let's do it now. You know what I mean? Let's get ready now.
It's never too late to prepare.
Yeah.
All right. The sooner the better, in other words.
Yep.
All right. Well, thank you, Dax. I'll share one funny, actually very interesting thing that happened. And, you talked about contingencies and, the election and all that. And I just had a deal cross my desk that was contingent on who wins the election. How funny or cool is that, right?
Yeah.
And what people, what a lot of people may or may not know is that you can draft a contract contingent on anything you want. It just, you got to get the seller to accept that contingency. But most people think it's contingent on a sale, right? Or contingent on financing. Well, guess what? I just saw a contingency based on the election. So be it. You know, you can make it contingent on anything you want.
We got 45 days left or something like that. Okay.
As long as the seller accepts it.
Yeah. Well, we'll see. Okay. Interesting.
Yeah, interesting. Yeah. Anyways, I hope you guys enjoyed what you heard. If you have more questions, just reach out to us. Our information will be right above here. And my friend Ethan will help us make that happen. And if you also have any questions or requests for future videos, content, comment below, because again, that really helps us serve you better, add value better, and doing all the things that we're doing a little better. So we need help us help you, right? Help us help you. And I hope you guys have a great day. Thank you, Dax. Thank you for participating and educating us.
Thank you.